Hello and welcome to Financial Accounting. Today we will continue with the topic of the statement of cash flows and learn how to calculate the amount of cash received from customers using the direct method when a company has write-offs of uncollectible accounts and changes in accounts receivable during the year. As we already discussed in previous videos, accounting standards allow the operating section of the statement of cash flows to be prepared using either the direct or indirect method. Today's video is about the direct method. If you would like to watch more videos about the statement of cash flows, I'm posting the link to the playlist here and in the description of this video. The cash flow statement, presented using the direct method, lists all the major operating cash receipts and payments during the period. We're going to learn how to determine the amount of cash receipts. And let's look at an example. Sullivan Corporation uses the direct method to prepare its statements of cash flows. Its trial balances at December 31st, years 2023 and 2022 are presented on the slide. Debits are presented on the left side and credits are presented on the right side. Since we need to determine the amount of cash receipts, we will need to use the following accounts and balances: accounts receivable for both years and sales revenue for 2023. Additional information is provided for this exercise. Sullivan Corporation purchased $5,000 in equipment in 2023. Sullivan Corporation allocated 1/3 of its depreciation expense to selling expenses and the remainder to general and administrative expenses. Bad debt expense for 2023 was $5,000, and write-offs of uncollectible accounts totaled $4,800. From the information provided, we only need to know the amount of write-offs during the year to calculate cash receipts. The following is required for this exercise. Determine what amounts Sullivan Corporation should report in its statements of cash flows for the year ended December 31st, 2023 for the following items: cash collected from customers, cash paid to suppliers, cash paid for interest, cash paid for income taxes, and cash paid for selling expenses. In this video, we're going to determine the amount of cash collected from customers. I will go over the rest of the items in separate videos. Sullivan Corporation prepares its financial statements in accordance with generally accepted accounting principles. It maintains its books on an accrual basis of accounting. As a result, revenue is recorded when earned, regardless of when cash is collected. Accrual basis revenue includes sales that don't result in cash inflows. Let's briefly review how changes in accounts receivable affect cash received from customers. If you would like to see more examples, I recommend watching the video Direct and Indirect Method of Reporting Operating Cash Flows. I'm posting the link here and in the description of this video. If accounts receivable increased during the year, this increase is subtracted from revenue. An increase in accounts receivable means that customer charges on account exceeded customer cash payments on account during the period. This excess is used to adjust the accrual-based revenues reported on the income statement to report the total cash received from customers during the period. If accounts receivable decrease during the year, the decrease is added to accrual basis revenue. A decrease in accounts receivable means that customer cash payments on account exceed customer charges on account during the period. This excess is used to adjust the accrual-based revenues reported on the income statement to report the total cash received from customers during the period. The direct method takes accrual basis revenue and adjusts it for changes in accounts receivable to arrive at cash received from customers. Now, let's look at how write-offs are recorded and how they affect cash paid by customers on the statement of cash flows. Estimated bad debts are recorded in the allowance for doubtful accounts account. Just a reminder, the direct write-off method, when write-offs are booked directly to the bad debt expense account, is not considered a method accepted by the generally accepted accounting principles, as revenue and expenses are not matched under this method. The allowance account is a contra-asset account. It is increased by credit and decreased by debit. When estimated debts are recorded, the allowance account is increased or credited, and the bad debt expense is increased or debited. Note that cash is not involved in this transaction. I have a video about the accounts receivable and allowance for doubtful accounts. If you want to watch it, follow the link which is posted here and in the description box. When it becomes clear that the account is uncollectible, the entry to record it is to debit or decrease the allowance account and credit or decrease the accounts receivable account. In our example, the write-off is $4,800. Let's get back to our example and look at the changes in the accounts receivable account. The balance in the accounts receivable account increased from $30,000 in 2002 to $33,000 in 2023. While it seems like the increase is only $3,000, we know that there was a write-off of $4,800 during 2023. Let's look closer at the T account for accounts receivable. The normal balance for accounts receivable is debit, as it is an asset account and is increased by debit. We start with recording the beginning and ending balances on the debit side of the T account. If you need to refresh your memory about the accounting equation and the rules of debit and credit, follow the link that I posted in the upper right corner or in the description to this video. The write-off amount of $4,800 is a decrease to accounts receivable and is recorded on the right or credit side. Now we can calculate the change in the accounts receivable account. The difference is $7,800, which is calculated as a $33,000 ending balance minus $30,000 of beginning balance and plus $4,800 write-off amount. Let's get back to the previous slide that shows how an increase in accounts receivable affects cash received from customers. To calculate cash received from customers, we need to subtract the increase in accounts receivable from net sales. Remember that accrual basis revenue includes sales that didn't result in cash inflows. And since an increase in accounts receivable means that customer charges on account exceeded customer cash payments on account during the period, we need to subtract the increase from accrual sales. Let's get back to our example and look at sales revenue for the year and how it is adjusted to get to cash received from customers. Sales revenue for 2023 is $538,800. This number includes both cash sales and sales that didn't result in cash inflows. We start with the sales revenue number, which is the total sales for 2023. We only need the 2023 number, as sales is an income statement account and includes all sales for the year, unlike accounts receivable, which is a balance sheet account and shows the balance as of the end of the year. The next step is to deduct the increase in accounts receivable account. We already calculated the increase in accounts receivable, and it is $7,800. Cash collected from customers is $531,000. This will be reported in the Operating Activities section of the Statement of Cash Flows. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Share this video with your friends and leave comments. Thank you all for watching, and I hope to see you all again on the next video.